All right, let's talk about dividend investing. It is, without a doubt, one of the biggest debates in the world of personal finance. I mean, should you be focusing on stocks that pay you cold, hard cash? Or is it way smarter to just go all in on pure, unadulterated growth? It's a question that honestly stumps a lot of people, and it was captured perfectly in a question I saw from a young investor just trying to figure out his future.
So let's take this question from James. He's 28, he's from Wyoming, and he's already thinking about the big picture. How to build a life where his investments can pay his bills, hopefully way before he hits 65. And his question really cuts right to the heart of this whole thing. Is building that passive income stream with dividends the right move, or is there a better way to play the game?
Okay, before we dive deep, let's just make sure we're all starting from the same place. So what is a dividend anyway? Well, it's actually super simple. When you buy a share of stock, you literally own a tiny, tiny piece of that company. You're an owner. So when that company makes a profit, they have a choice. They can decide to share some of that profit directly with you, the owners. That little cash payment that shows up in your account, that's a dividend.
To really answer James's question, let's explore one side of this argument first. This is a major school of thought, and the perspective goes something like this. If you're a young investor, focusing on dividends isn't just a little less effective. It could actually be a big mistake that holds back your long-time wealth.
So here's the thinking. The companies that pay out juicy dividends are usually these massive, mature, blue-chip companies. Think about a company like General Motors. They're rock solid, they're profitable for sure, but their days of explosive 10x growth, they're probably in the rearview mirror. And because of that, they often just have a lower rate of return compared to scrappy growth companies that are pouring every single dollar they make back into the business to get bigger, faster.
So what's the alternative plan? It's called the total return strategy, and it's incredibly straightforward. You invest your 15%, but you put it into a mix of growth-focused mutual funds. You flick on the switch to reinvest everything automatically. So even if you get a small dividend, it just instantly buys you more shares of the fund. The whole idea here is that passive income is the goal for when you're done working. It's for retirement. Right now, in the accumulation phase, the only goal is to make that pile of money grow as big and as fast as possible.
And look, on a spreadsheet, that makes 100% sense. Of course you want the highest number. But here's the thing. Investing isn't done on a spreadsheet. It's done by human beings, with all of our weird emotions and biases. And that little fact brings us to the other side of this great debate.
Okay, so now let's flip the script. Welcome to the defense of dividends. This way of thinking argues that when you only focus on the highest possible return, you're ignoring two things that are absolutely critical. Who actually has control over your money, and, maybe even more importantly, how your own behavior affects the returns you actually get in the real world.
Now, before we go any further, we have to tackle the big elephant in the room, the biggest mathematical criticism of dividends. And you know what? The critics are 100% right about this. Dividends are not magic free money that just appears out of thin air. When a company pays you cash, that cash has to come from somewhere. And it comes directly out of the company's value, which is reflected in its stock price.
Let's just walk through exactly how this works, because it's pretty interesting. Imagine a stock is trading at $100 a share. The company then earns $5 in profit for that share. The market sees this, and maybe the stock price bumps up to $105. Then the company says, okay, we're paying a $4 dividend. The day it goes ex-dividend, which just means anyone who buys it from this point on doesn't get that payout, the stock price will, almost like clockwork, drop by $4. So you get $4 in cash, and your stock is now worth $101. Your total value? Still $105. Nothing was created or destroyed. So if the total value is exactly the same, what's the big deal? What's the real difference? Well, it all boils down to one word: control. With a growth company that pays no dividend, you are trusting the management team, the CEO, and the board to wisely invest 100% of your share of the profits. But with a dividend-paying company, they invest some, but they hand your share of the profits back to you in cash. And now you get to decide what to do with it. You can reinvest it, you can spend it, you can put it in a completely different investment. You're in the driver's seat. And this right here brings us to the absolute heart of the debate. It's not really about what strategy is right or wrong on paper. It's about this massive gap between what looks best on a spreadsheet and what actually works for a real, live, emotional human being. I mean, let's be honest, the math is pretty darn clear. If you just look at these Vanguard funds since 2007, the main growth fund delivered an average return of over 11% a year. That smokes the dividend funds, which came in at 9% and just under 8%. So yeah, the numbers don't lie. Over this time frame, growth won. Case closed, right? Well,
Not so fast.
Because this slide shows you what it actually feels like to live through those average returns. Imagine buying Meta stock 5 years ago. Yeah, you'd have a nice gain today, but to get there, you would have had to stomach watching your investment get absolutely crushed, down to 53 bucks. Then you'd have to resist selling as it rocketed up to 380, only to watch it get cut down by more than 75% again, all the way to 90 bucks. That is a white-knuckle ride.
And the truth is, most people just can't handle that kind of volatility without making a big mistake. A recent study found that 2/3, 66% of investors, admit they've made an impulsive, emotional investing decision that they ended up regretting later. It's so easy to say you'll stick to the plan, but when your life savings are vaporizing, it's a whole different story.
And this is the secret weapon of dividend investing. It's a huge psychological advantage. Picture the market is in a total freefall. Your portfolio is bleeding red. But then, ping, a cash dividend payment hits your account. It's this tangible proof that the business you own is still chugging along, still making money. It shifts your focus from the wild, crazy stock price to the steady, growing income stream. And that can be just the thing that keeps you from panicking and selling at the absolute worst time.
So where does all of this leave us? Well, it shows us that there's no single best strategy for everyone. The right answer isn't about figuring out which approach is mathematically superior. It's about being honest with yourself and figuring out which approach is superior for your personality, your goals, and your unique temperament.
Let's just put it all side by side. The pure growth investor, their primary goal is the highest possible total return, period. They're willing to be hands-off and tolerate insane volatility to get that maximum compounding. On the other side, you've got the dividend investor. Their main goal is a predictable and growing income stream. The key benefit is that psychological stability and the control they get over their cash flow. They see themselves more as a hands-on business owner, valuing that consistency even if it means a slightly lower peak return.
So at the end of the day, the answer to James's question, it really just comes down to this one. And it's not about James anymore, it's about you. What kind of investor do you want to be? Are you the type of person who can truly stomach the chaos and stay the course for maximum growth? Or are you the type of person who would thrive with the control and the mental comfort that a steady stream of dividend income provides? Because the best strategy in the world is useless if you can't stick with it.